Are you live, Mickey? Good evening, ladies and gentlemen. Welcome to our quarterly call. We shall wait for a couple of minutes for all the participants to join in. Sandip, allow us a couple of minutes till the time all the participants join in, then we'll start shortly.
Sure.
It's around 3:33 right now. We'll start by 3:35, I believe, by the time participants also join in. Okay, Sandeep, I believe we should start the call now. I'm sure by the time more participants will join in as well. Once again, a warm welcome to all of you at ASK Investment Managers quarterly call. I am Gaurav Chakravarti and I'll moderate today's call for you. Let's have a quick check on how our economic health stands. Indeed, it gives me a lot of pleasure to say our economy has sustained its momentum so far in FY25. We experienced a notable upswing across various high-frequency indicators, signaling a strong and resilient business activity. Continuous growth in GST collections and more so ever, double-digit growth in e-way bill generation further helps in catalyzing growth and confidence. At the same time, the stock market indices are also reached a record high numbers. With respect to capital flows, FPIs reversed their trend in June 2024, becoming net buyers. Now, supported by the robust capital flows, our foreign exchange reserves have reached a historical high number of $675 billion, which is sufficient to cover almost 12 months of imports. All this reflects resilience of the economy to sustain its growth path amidst ongoing geopolitical headwinds, and that forms the part of our discussion. For that, we have Mr. Sandip Bansal, Senior Portfolio Manager at ASK, with us to assess the current condition prevailing both in global and domestic front. And he shall take us through the highlights of our ASK Growth/India Select portfolio. ASK's growth portfolio, being one of the industry's first PMS investment approach, launched way back in 2001 and now has a track record of more than 23 years. And in this period, it has compounded at a rate of 19%. 1 crore invested in ASK Growth in Jan 2001 stands at 64 crores as of now. Sandip comes with a 2 decade of WalkX with more than 15 plus years in equity market. He has been instrumental in managing our portfolio since the time he has joined us from SBI Life, where he was the head of investment research leading across asset classes. He comes with a strong educational background. Sandip is a chartered accountant, company secretary, and MBA from IIM Ahmedabad. Today, we have scheduled an hour for this webinar where I request Sandip to cover product trends of the market and the growth drivers for Indian economy, followed by a deeper understanding of the strategies, insight on what happened in this financial year so far, where we stand now, and how we see things going forward. This will be followed by Q&A. So I request all the participants to type in your questions and queries, and we shall curate and try them answered. Over to you, Sandeep.
Thanks a lot, Gaurav. Thank you so much, everyone, for logging in. I'll just be sharing my screen, Gaurav, and hopefully it's visible. Please do let me know.
Yes, Sandeep.
Okay, thanks. So if we look at the calendar year so far for the country, we have seen positive macro external factors and internal factors for us, with IMF raising our growth forecast by around 50 bips and projecting a 7% kind of a growth rate in FY25. This comes on the back of 8.2% growth that we've experienced in FY24. RBI has also scaled back its inflation projections by around 20 bips to 4.6% for CY24. We've also seen a 20 bips downward revision in our fiscal deficit to 5.1% from 4.9% from 5.1%. Our current account deficit is also lower in Q4 by around 40 bips versus Q3. And while the election outcomes have been underwhelming versus original market expectations, there is reassurance of policy continuity. And on the monsoons front, the earlier El Nino conditions have now transitioned to La Nina, which is supporting the overall rainfalls in the country. So the external as well as the internal macros of the country and the economy have improved during the course of this calendar year. If we look at the earnings season that has just gone by, and we will have a snapshot of the various sectors. Autos, we saw two-wheelers and PVs perform well, while CVs and tractors had a muted performance. The performance of two-wheelers and PVs was supported by volume growth as well as margin expansion. On the banking side, there was pressure on NIMs due to high cost of funds. There was also pressure on deposit growth. Credit costs were slightly elevated compared to the recent past, where they were actually at very low levels, which kind of impacted PAT growth. On the other hand, the capital market focused businesses in the BFSI sector continued with robust performance. If we come to the chemicals space, we saw pressure continuing due to inventory destocking and pricing pressures, and the performance is likely to improve from the second half of this year. If we look at commodities again, performance in terms of profitability was subdued. Ferrous companies also, we saw a similar kind of an impact, and they continued to face headwinds. On the domestic consumption side, there was positive news in the sense that demand slowdown has now shown signs of stabilization for staples. And we've also seen early signs of bottoming out of the degrowth cycle. And again, there is hope for recovery in the second half of the year. Consumer durables, particularly things, products like air conditioners, etc., had a strong quarter supported by heat waves across the country, and other consumer durables categories have also shown improving trends. On the capex side of the economy, we've seen good mixed kind of numbers from a results perspective. Obviously, this was a quarter which was impacted by election outcomes. In some parts, the heat wave also impacted construction activity. So some kind of a muted overall environment was expected, and in parts it has played out, while pockets have also shown good performance. On the IT sector, earnings and top line seem to have now stabilized. Hiring trends have been mixed. There had been reduction in hiring over the last 5 quarters, but now we've seen slight improvements in few pockets. On the oil marketing companies, the refining margins were under pressure, though they again have bottomed out, and we have seen improvement in the current quarter of the year. Marketing margins normalized partially offsetting the weaker refining segment results. On the pharma side, domestic volume growth was relatively stable, and lower input costs aided margin expansion. And on the hospital side, volume growth was relatively steady. If we look at the overall picture of the market, then revenues and profits have grown about 8 to 10%. We are seeing profit growth and revenue growth in some sense converging. We are also seeing the large divergence across market caps in terms of growth numbers somewhat converging, and across also different ownership patterns also converging. Net, it does seem that, while the current quarter had a single digit kind of a growth number, and that was kind of expected due to elections, heat waves, and the current quarter also might not be very exciting, could be a bit muted again because of a weak seasonality. But from management commentaries and outlook, it does seem that the second half of the year is going to be robust. If we look at monsoons, the importance obviously cannot be over highlighted, because around 65% of our population is in rural areas. Around 45% of the labor force is dependent on agriculture, and the agriculture share of GDP is around 15%. Initially, in the initial months, monsoon was weak, and it was feared that we are going to have deficient rainfall, but there was very good coverage and pickup later on, and so far the deficit has been more than covered. Obviously, from a spatial distribution perspective, like always, we have areas of over rainfall and areas where rainfall has not been that adequate. But overall, from a country perspective, monsoons seem to have been at normal levels so far. What is the outlook going forward? The biggest aspect is on disinflation and interest rates. This is something which we are seeing globally. The US Fed chair has also indicated that Fed might now need to have to adjust its policy in line with inflation trends that are being seen in the US as well. Global growth, which was resilient so far, as you would recall that through the last about 1 year or so, there have always been fears of a US recession and global growth getting impacted by various geopolitical conflicts. But surprisingly, growth was resilient. But now there are some signs of global growth per se weakening. On the election outcome and on the budget, we have seen that there is greater focus on job creation, which will ultimately also lead to pick up in consumption in the country. We will be keeping a watch on the US elections and the policies of the new US government, because that will have an impact on global trade and global geopolitics. From an earnings growth perspective, a low to mid-teen kind of an earning growth is continued to be expected for India for the next couple of years. In terms of the focus areas or areas that we are keenly studying, and parts of which are also reflected in the portfolio actions that we've undertaken. One is the recovery in the CapEx in the country, continued investments in CapEx in the country, driven primarily by the government as of now, likely to be supported by the private sector from the second half of the year. Reduction in interest rates should be helpful in that direction. A pickup in demand will obviously increase risk appetites and also give greater confidence to corporates to invest in creating newer capacities for growth. And the buoyant capital markets and the capital raising that has been done will definitely aid the corporate CapEx cycle. We are seeing massive investments in green power and the entire green energy value chain. And we are studying that sector closely to scout for investment opportunities. Then automation, digitalization, all of these are also creating newer opportunities both for the IT sector as well as the engineering sector. These are likely to see massive changes in terms of technology going forward. And we are again closely watching the space to identify the right investment opportunities. The focus on defense, railways overhaul kind of continues because of the underinvestment that we have seen in these sectors for many decades in the past. And these sectors will continue to witness increased focus from the government. Also, policy initiatives like the PLI scheme, ramp up of the existing PLI scheme beneficiaries in terms of production will also benefit the overall manufacturing sector and throw up newer businesses, newer business models, and newer companies in the listed space. On the consumption side of the economy, because of the job creation focus in the budget, we will see higher consumption levels at the bottom of the pyramid, and higher income levels should also lead to increasing penetration in many of the under-penetrated categories in the consumption sector. What are the key risks that we are seeing in the market? Most of the risks, in our view, are global in nature. The key domestic risk that we saw more so in the earlier part of the year was the monsoons. That concern seems to be getting assuaged as the monsoons have kind of been fine so far. But on the global side, geopolitics is something which we'll keenly keep an eye on. As long as the conflicts are localized, the markets have kind of adjusted to that and moved forward. But if, God forbid, more and more countries get involved, or these conflicts drawn for a longer period of time, it could have a far greater impact on global economy and global growth, which is anyways showing signs of weakening. The second impact, which is again an area to be watched out for, is global growth. The high interest rate environment that we've seen for the last 1.5 years or so has obviously had an impact on inflation coming down, which was the desired objective, but it has also had an impact on growth. And this does have a bearing on India's exports, while part of it is offset by China plus one in global diversification of supply chains. It will net still have some impact, and that is something which we are keenly watching. Obviously, the reduction in interest rates globally should help in pickup in growth, and this concern could also get addressed as we move forward. How all of this kind of summarizes into Nifty valuations. So if you look at this chart, which shows Nifty's valuation for the last decade or so, which is maybe the more relevant period to look at, we see that Nifty valuations are definitely not cheap, but it also shows that we have been at higher levels previously as well. Few things which need to be kept in mind are that from a global perspective, India's narrative is really strong. Secondly, from an earnings growth perspective, Indian economy as well as the Indian markets remain one of the few markets that offer double-digit growth rates in terms of earnings for the foreseeable future. And India continues to be a large domestic market and a potential hub for manufacturing globally due to diversification of global supply chains. So because of which, fundamentals, narratives, as well as flows on the domestic side especially continue to be supportive of the Indian equity markets. Having said this, one context that we need to keep in mind is that globally equities as an asset class has been doing well. If we look at the returns of most large global economies, they have been quite healthy. Obviously, with the exception of countries like China, and maybe Brazil has not done that well, but the US, Japan, and a lot of the European economy markets have actually done very well in the last few years. So the Indian market returns have to be kept in context of the what is happening to equities globally as an asset class. Now moving on to the specifics of our growth and India Select portfolios. If we look at the market cap breakup, around 50% plus of the portfolio is comprised of large caps, and the balance is comprised of mid caps and small caps, with small caps, making less than 15% of the portfolio. There have been no major changes in this breakup. While we do not pick up stocks on a market cap basis, and what we see in this slide is an end result, it essentially shows that we have good diversification across market cap criteria in our portfolio. If we look at the sectoral breakup and where our big bets lie, about 1/3 of the portfolio is levered to the capital investment side of the economy, which is engineering, construction, industrials, and this comprises a whole host of sectors, including railways, ports, cement, capital goods, pipe companies, etc. All of this we've categorized under engineering and construction. Then around 1/5 of the portfolio is comprised of BFSI, where we have some of the leading banks and NBFCs in the country. Then around 15% of around 1/6 of the portfolio is comprised of consumer-facing businesses. Around 5% each is comprised of autos and chemicals and oil and gas, while the balance is brought up by telecom and healthcare. So we believe that there is a good diversification across sectors. Our stock picking style continues to be on a bottom-up basis. This is again an end result, and we will continue to populate stocks wherever we see opportunities, and that would be across different sectors. The key changes that we've made since the last call, all the exits have been to fund our new entries. We've added Mankind Pharma, which is the largest, which is amongst the fastest growing large pharma companies in the country. In the last decade, it has grown around 3% higher on a CAGR basis over the industry. It is out of its total portfolio of top 20 selling brands, 18 of its brands are in the top 3 molecules in those sectors. And really large company which is growing fast with an aggressive management. Around 1/3 of its portfolio is focused on the chronic side, where they have around 1.5x coverage, and they have huge space for increasing productivity of their medical representatives, which is also going to boost the profitability through operating leverage. We've also added Maruti Suzuki. Maruti Suzuki is adding around 10 new models over the next several years. Most of around half of it is going to be in EVs. Most of them are going to be SUVs. It is investing heavily in increasing its distribution reach further. It already has the largest distribution among auto companies in the country, and it is also doubling its capacity by 2031 from 2.3 million units currently to 4.6 to capture the large opportunity in the auto space. We've also added KPIT Technologies, which is one of the leading players in the software-defined vehicles category. It is 100% auto-focused ER&D player. It has relations with 12 of the top 15 OEMs in the world, and out of them, maybe with 10 of them, it has relationships for more than a decade. Auto is seeing a huge transition where things like assisted driving, increasing infotainment requirements. There is a net, there is increasing software component in the auto vehicles, in the auto sector, and KPIT is one of the leading players out of India, which is addressing it. It has a very interesting role to play in middleware, which sits between the operating system and the applications. Very high return ratios and very good growth over the last few years, as well as going forward as well. So these are the key changes that we have made in the portfolio since the last call. How has the performance been of our portfolio companies? We have seen good growth versus the benchmark in the quarter gone by. Similarly, going forward as well, we are expecting around 20% kind of earnings growth levels for our portfolio companies versus around 13 to 15% for the Nifty, which is, let's say, around 50% better growth levels going forward as well. While those were the projections, how have our portfolio companies fared in the past? In the past as well, we have seen that the portfolio companies have delivered earnings which have been better than the Nifty. So these are last 5 year CAGR levels. So it is not just that we are forecasting a healthy growth. These companies, because of the inherent strong moats and good managements, have managed to deliver superior growth in the past as well. The P ratio of the portfolio versus the average of the last 6-7 years for which we have data on this slide is lower than historical levels. Part of it is to do with the mix changes that have happened in the portfolio, and part of it is also to do with the fact there has been some derating in the portfolio, because while earnings have grown, maybe stock price returns have not been at similar levels. Net, our outlook on earnings, the potential of our underlying portfolio companies, and the outlook continues to remain robust. We will continue to make the required changes in the portfolio that are required to bring in more and more companies that reflect the higher growth potential of the economy. So thanks a lot for your patient hearing, and Gaurav would be glad to now take any questions that are there. Thank you.
Sure. Thank you so much, Sandeep, for the detailed brief on the market as well as on the stocks which you have added in the recent past. I request all the participants to type in your questions on the chat box, and we shall try to curate all of them. In the meantime, the question comes in, Sandeep, we have already got some question in advance for you. When you speak about the valuation, when you speak about the growth or the good quality, and also we have shown the composition in sense we have a large cap composition is little higher on this portfolio. Also, we recently concluded the Jackson Hole, right? So now, is Jackson Hole indicates anything on the cut in interest rate in a shorter time? Because this will actually help the high growth, high P companies to come back into their earlier mojo.
Sure, Gaurav. I think that's a fair observation and expectation. Market expectations have obviously increased of a rate cut in September. The Fed was obviously waiting for inflation in the US to cool down, which would have kind of achieved Fed's objective, while the inflation rate targeted is more like 2%. They know that that is more of an aspirational number which is going to be achieved over time, and what they are more focused on is the directional cooling of interest rates, and whether they have the comfort that we are past the high levels that were seen previously, and structurally inflation has been brought under control rather than achieving a specific targeted number. I think that goal seems to have been, is more or less in sight, and it does seem that the Fed is on course to cut interest rates from September. What is going to be the quantum of cuts, whether it's going to be 25 bips or 50 bips straight away, is something which would need to be watched out for. Yes, this is an event which everyone was anticipating and waiting for, because this was kind of an expectation through this year, but it was not materializing. But yes, finally it does seem to be in sight. And does it benefit high growth kind of investing style? The answer is yes, because high growth stocks generally have a large proportion of their value coming from future, and a lowering of interest rates should logically help the valuations of those businesses. The other question which arises and is related to this is that will the Indian Central Bank or the RBI respond immediately, or is it going to come with a lag? That is again something which would need to be seen. Maybe the RBI does not start cutting the interest rates in India immediately. Maybe RBI would want for some greater comfort levels on domestic inflation, but at least the global direction of interest rates would be set after what the Fed does perhaps in September.
Thanks, Sandeep. Some interesting question on the chat box. Somebody have asked what makes unique ASK growth a unique portfolio in itself and also among competitors. Though I have, highlighted in my start that this is one of the oldest, has a track record of 24 years and has compounded a growth of 19%. So apart from this, any other points which you want to highlight that how our portfolio is different or, slight, different from the competitors in the market?
Sure. So this is a portfolio which is a sector agnostic portfolio. It's a market cap agnostic portfolio. We continue to buy the leading businesses in the country across market caps, sectors, but which are leading businesses in their respective categories. We continue to believe in concentrated holdings, and hence we keep a maximum number of around 30 stocks in our portfolio. So this is a concentrated portfolio. We would like to benefit from compounding, and hence would not like to trade in the portfolio in terms of looking at short term, but the focus is going to be more on the long term. The growth profile of the earnings of the portfolio, it has to be at a minimum of 15%. But what we've seen historically is that the nature of the businesses that we've bought are more likely to grow in the ballpark of 20%. The return on capital of the businesses is also quite healthy. While a minimum threshold is 20%, we've generally seen that it is more like 30%. So to summarize, this is a portfolio which buys the leading businesses in different sectors of the economy, which are showing high growth, across market caps with a focus on long-term compounding.
Thanks, Sandeep. I believe it answered the question. Now going to the other question, I'll club this question together. Somebody have asked that is the equity market overvalued? And as well as what are the sectors ASK is currently bullish on? This is not in specific to ASK growth, but in specific to ASK is bullish on the sectors and as well as the valuation of the overall market.
Sure. So the markets are at all-time highs, and definitely the markets do not look cheap. But just because markets are at all-time highs doesn't mean that they cannot go higher. As we've seen in one of the slides in the deck, most large global markets have done well, and many of them are at all-time highs or close to their all-time highs, whether it be Japan, US, and some of the European markets as well. So this is a global rally in equities as an asset class, perhaps. From an Indian perspective, this is not only a rally which is supported by liquidity, which many believe to be the case, because while foreign FII investing in the country has been a bit volatile, domestic liquidity has been quite supportive, whether it be in terms of SIPs, which we've seen have kind of trebled over, more than doubled over the last 3-4 years, and because of HNI, retail participation, etc. But this is also supported by good earnings growth across sectors and across market caps as well. So there is also there is a strong fundamental leg to this rally as well, because the earnings have really been good. And if you look at the various the key segments of the economy, if you look at the banking balance sheets, they are solid, because the NPAs problems are largely behind. Profitability has been good, and banks have, a lot of them have also raised capital over the last few years. If we look at the corporates, we have seen a lot of IPOs, a lot of capital raising, a lot of private equities have also exited, and perhaps now they will start to look to make fresh investments. The government has also improved the quality of its expenditure over the last few years. So the various engines of the economy, whether it be corporates, households, and households have obviously at least, the upper segment have kind of benefited from the wealth creation. So the key engines of the economy seem to be in fine fettle. The external factors, the macro fundamentals of the economy also look to be solid. The narrative for India, especially in a relative global context, has perhaps never been stronger because of global diversification of supply chains, etc. There is increased focus, and we would expect a pickup in FDI, a pickup in the private sector capex cycle going forward. So all of these things, the narratives, the numbers, the liquidity is supportive. Just thinking about valuations alone might not be the best idea, and we would have to keep other factors in mind. And honestly speaking, when markets were kind of, let's say 10% lower, then also valuations were not particularly cheap. And obviously specific stocks would have done far better during this time period. That is the framework which one should use while thinking about stock markets. And, there is still opportunity for longer term investors with disciplined investing approach. As far as, sorry, your second question, Gaurav, was
the sectors we are bullish on, or we are
yes.
looking ahead for.
So, as we can see in the growth portfolio as well, there are sectors in the economy where we are seeing increased policy focus, which is manufacturing, infrastructure, energy, and all that related ecosystem is something which we are positive on. The budget has provided incentives for job creation and increased employment, and we have seen a good few years of poor growth in the consumption sector and also underperformance of that sector. So to that extent, that is a space also which is likely to come back in some sense. Partly it has already happened, and maybe there is more distance to go. So we do really like the discretionary consumption space. So this overall basket, as well as comprising of manufacturing, industrials, engineering, energy, etc., and the consumption space, especially on the discretionary consumption side, are the areas which we like.
Great. Sandeep, we have some stock questions which I'll take further, which are on the chat box. Sandeep, when you talk about infra, the movement in the PSU in the portfolio, the railway port, automatic question comes to the mind that is the latent value still on for the current darlings of the market, like for the PSUs or a sport, railway, defense. What's your current take on that? Though you give the the wider valuation perspective on the market, in specific to this particular segment of stocks, what's your take?
Sure. What we have seen post the pandemic is that the government really started investing in the economy, and maybe partly it was to restart or kickstart a COVID battered economy. And the government as well as the PSUs were at the forefront of this, and they led investments. And the government also had its agenda of overhauling a lot of underinvested areas previously, whether it be railways, defense. Over the last few months, because of elections, there was a slowdown, yes, because government activity does slow down during this period. And post the government formation, it really does take a bit of time to kind of pick up to be reflected, because of which we saw muted numbers in parts of this overall industrials infra kind of a space. And maybe, because of the weak seasonality in the current monsoon season, it could continue. But one would expect that this trend is solidly going to continue going forward. So we really do not have any doubts regarding that. India does want to increase manufacturing as a percentage of its GDP from under 15% currently to 25%. Obviously, this is going to be a journey, but this journey implies that there needs to be a lot of investment in infrastructure, in energy, and obviously PLI kind of schemes or similar kind of government measures, whether it be ease of doing business, etc., are going to continue going forward as well. We do, and we believe that the growth that these companies are going to experience is going to be really high, and it is also going to be for a relatively longer period of time. And when high growth continues for a longer period of time, then near-term focused valuation metrics do look elevated. But if one has a longer time horizon, then we believe that there is money to be made in these spaces. So we continue to remain positive, and we continue to remain invested, and are in fact scouting for more opportunities as and when they provide themselves.
Okay, thanks, Sandeep. Sandeep, now in respect to our performance overall, I go by the last 1 year performance, which has been good in specific. However, we are marginally down from the benchmark. And could you please, help us understand the specific detractors, or what do you think will help in loading the gap going ahead in terms of the relative
Sure.
performance?
Sure. So there have been few sectors, few stocks which have impacted our performance. Let's say chemicals was one of them. Chemicals, we've seen a global destocking cycle led by the weakened demand situation in China, which also led to weak pricing and perhaps dumping, which impacted chemical businesses. We were also impacted by lower exposures to sectors like pharma, autos, etc. So what have we done in each of these spaces? On the chemical side, there were some stock specific aspects as well for our portfolio companies. We believe that the worst is likely behind us, and on a sequential basis, we are likely to see improvement. So that in itself should help us, bridge the gap. Secondly, on the autos as well as the pharma side, we have increased our exposures. Obviously, in those names where we have greater comfort, both from a growth perspective as well as from a valuation perspective. The IT name that we've added is also actually 100% auto-focused ER&D play. So, the fundamental performance of these businesses should help the portfolio prospects going forward. In addition to this, there is a certain percentage of the portfolio which has delivered the earnings but has still underperformed because the markets were looking elsewhere or focused on other sectors, stocks, which were doing better. But at some point of time, if there is continued earnings delivery, the market's attention to these stocks will come back because valuations can be suppressed for quality businesses only for that long. So we believe that there is a latent valuation potential in some of the businesses that we own, which have performed from a business delivery perspective, but not necessarily from a stock price perspective. So that valuation potential will also release itself going forward in our view, which is going to help us improve the matrix on the performance side. In addition to this, Gaurav, we'll obviously continue to make whatever changes that are required in the portfolio wherever we see greater growth and money-making opportunities.
Great, Sandeep. So when we talk about the changes in specific, let me ask you a question that what would the trend of a portfolio turnover going ahead in respect to the current scenario of the market?
So generally speaking, we would not like to make too many changes in the portfolio just for the sake of making changes, because we continue to hold businesses for a relatively longer period because we buy them on their potential, and that really does take its time to get realized. So if you look at it, anyways, the changes that we've made in the portfolio, have not been too many. So versus the market in general, I think the changes are not going to be high. As and when opportunities present themselves, obviously we would like to participate in them. As and when we believe that there are specific pockets in which we need to book profits, we will do that as well. Or from a risk management perspective, if we believe that weights in certain stocks have exceeded our levels, or there are weights in certain stocks that we need to beef up, we will continue to do that. So uh, overall, given the market context, could portfolio churn levels be slightly higher than what has been the historical experience cumulatively of this portfolio? Maybe the answer is yes, but is it going to be significantly, but is it still going to be lower than what the market is generally used to? Maybe the answer to that is also yes.
Thanks, Sandeep. In the meantime, request all the participants to type your question as we are nearing almost to the end of this webinar. Now, Sandeep, I'll take some stock-specific questions. It is building up right now. When you speak about, pharma, pharma index is at the top of the town right now. So throw some light on the, more rationale behind buying Mankind Pharma at this point of time.
Sure. So, as I said earlier, Gaurav, Mankind is one of the leading pharma companies in the country. It has managed to grow at a 3% higher per annum CAGR level for the last decade versus the industry overall. So while the industry grew at a 10 odd percent, Mankind grew at 13% plus. Uh, out of its top 20 selling brands, uh, 18 featured in the top three of those respective molecules in the industry. The management, is a solid and aggressive management. They have been able to build a very large pharma business in a relatively shorter period of time. Around one third of their sales comes from the chronic segment, wherein they have scope to improve their medical rep productivity, which is also going to help operating leverage. So, this is a very solid domestic franchise, which we believe has robust long-term growth potentials. And, hence we've added the name to our portfolio. And we believe that business prospects are really good because the management is really trying a lot of things to scale up their growth as well.
Great, Sandeep. Sandeep, we have sold HAL. You also mentioned in the presentation. And there's a narrative in the market that post selling the stock, it has moved. And that's a fact. The stock has moved tremendously. So your call on it. I'm sure that we have, replaced with we have taken the money out and invested into some other stocks. So your take on that particular question.
Sure. So that was largely to create liquidity for our investments. And we had essentially booked profits in that name and put in money in names like Mankind, KPIT, etc. We have a good exposure to that space. We continue to hold Bharat Electronics in the portfolio. And we continue to scout for more and more opportunities in this space. As and when we find that there is a name which fills our parameters and our matrix of risk reward over the longer term, we are fine to add a new name or another name in the same sector. So, it is not that we've turned negative on the sector because, as I said, we continue to hold Bharat Electronics, which is again a leading player in the strategic electronics space in the defense sector.
Thanks, Sandeep. What is happening with APL Apollo? It has shown a lot of promise at the start when you took, and inspired is having a very good capex also in the particular stocks. Your take on that?
Sure. Yes, APL Apollo has been impacted due to lower margins. APL Apollo is perhaps the leading global player in structural tubes. It is obviously the leader in the country and perhaps the largest globally as well. Its volume ramp up is really strong going forward. While margins, have left a scope of more to be desired, but we continue to remain very excited about the long-term growth prospects of the company. They have capacities in place. They have a very strong innovation engine, which helps them bring first to India kind of products, which no one else has. They have continued to have the largest dealer network in the country. They continue to have the largest number of SKUs, which is far more than the nearest competitor. They continue to manage their inventory levels extremely well. And yes, while the stock has not done well in recent times, the fundamentals of the business continue to be solid. In businesses, there can be periods of volatility, but if the management is continuing to execute and the long-term prospects remain solid, we are fine to see through that volatility.
Great, Sandip. Also, there's another stock, Syrma SGS. Again, that has been a detractor to the overall performance of the portfolio. What are you doing? What are you in specific doing with that particular stock?
Yes, so the business performance of Syrma SGS has certainly been below what we were expecting. While the top line growth has been far ahead of expectations, because of a mix change in the business, margins have been far, far lower. And, that has resulted in the stock underperforming the benchmark as well as our expectations. We are keeping a close tab on the business. Syrma SGS is one of the leading players in the space of electronics manufacturing services. The size, scale, capabilities of the business continue to be in place. The opportunity size of EMS in the country is really huge, and the growth prospects are also very solid. If we speak to most of the companies in the space, they tell us that the visible growth for the next 3 years or maybe 3 to 5 years even is in excess of 30%. So the overall space continues to be exciting. This company has delivered on revenues, but has failed to deliver on margins. So we are keeping a close tab on the business. We like the space. We have seen some pain, as you rightly pointed out, due to holding the stock. So we are focused on, improving prospects in the business. And if we find that, there is no turnaround in the margins, then we will obviously have to take a call.
Okay, thanks. Sandip will take 2 more questions and then we'll end the session. You spoke about monsoon, and when you spoke about monsoon, obviously the name came to our mind is Patanjali. What's cooking in Patanjali right now, and how you are seeing Patanjali going ahead, favoring into our portfolio performance?
So Patanjali is one of the FMCG staple names that we are owning in the portfolio. The company has a very large product suite which it has to offer. In addition to its foods business now, there is another set of business which is also coming to it. The distribution reach of the business is far lower compared to its peer set. So they have a lot of scope to increase their pan-India distribution levels. There is a space for the product profile and positioning of Patanjali, whether it be in terms of Ayurveda, health, herbal, naturals. And the company is a leader in the edibles oil space and in a number of the food categories that it offers. And it's a very strong challenger in many of the others. With the overall consumption in the economy, the sector itself seeming to have bottomed out, and with the execution that hopefully the company will deliver going forward as well, we continue to hold a decent enough position in the stock.
Thanks, Sandeep. Reminder to the participants, we are almost at the end of the session. We'll take one last question. Sandeep, your take on Titan. After a good rally, Titan has again gave a halt the way it does. So what's your take? And also with the gold prices again coming back after a fall, how things pan out for Titan in specific?
Yes, so in shorter periods, we have seen that gold price could have an impact, because higher gold prices essentially imply that jewelry purchases could get postponed. But over a period of time, we've seen in the past as well that these things start to normalize as consumers peg their reference levels to the new gold prices, which are obviously at higher levels. The company has delivered well in the past. The growth, given the size that it has achieved, the growth levels are still quite good. The management has the track record and the credibility to execute going forward as well. And the opportunity size in itself continues to remain large. This is obviously a stock which has never been particularly cheap. So, that is something which obviously always keeps bogging fund managers like ourselves at the back of the mind. Yes, but other than that, the business prospects are good. The industry is, for the scope for organized retailing is still continues to be large. Just keep the valuations in mind.
Yes, Sandeep, I agree with you. Always there's a saying, quality comes at a price.
Yeah.
Sandeep, on that note, would request you to give some closing comments, and after that we shall close the session.
So overall, we are quite comfortable with the way the portfolio is positioned, whether it be in terms of sectoral allocation or on a bottom-up basis, from an earnings growth perspective, or from the quality of the portfolio in terms of return on capital or the balance sheets of the portfolio companies or their competitive advantages. We have made a number of changes in the portfolios over the last many months, which should reflect in performance going forward. And there is a part of the portfolio where earning delivery has come through, but stock price performance has not been concomitant, which we believe is also going to reverse going forward. So net, we continue to remain excited and positive on the portfolio prospects. And any changes that are required, we'll anyways be very watchful and agile in doing the same. And thank you so much for your time and your patient hearing.
Thank you so much, Sandeep. And thank you all the participants for attending today's call. And we shall be sharing a recording of the same. And this concludes today's call. Thank you everyone.
Thank you.